Hey there, financial navigators. Welcome back to the channel where we demystify the markets and uncover unique opportunities. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the mechanics behind a potential short squeeze. Our screener has flagged a microcap name, BIYA, with some truly eye-popping cost to borrow figures that demand our attention. This isn't just about finding a stock, it's about understanding the intricate dance between short sellers, supply, and demand. So buckle up, because we're breaking down everything you need to know about BIYA and why it's appearing on our radar. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Sure, BIYA logo/ticker on screen. Let's talk about BIYA. This is a micro-cap company, and while specific sector information isn't readily available for our analysis today, what caught our eye are the underlying borrow dynamics. This company has an estimated float of just 2.7 million shares. Now, when we look at recent price action, BIYA has been exceptionally quiet. Over the last 5 days, the stock has seen a 0.0% change, and looking back 30 days, it's also at a flat 0.0%. Even today, the change is 0.0%. The volume tells a similar story. Today's volume is 0 shares, the 30-day average volume is 0 shares, and its relative volume is 0x average. While this might seem like a stock in hibernation, these flat lines can sometimes precede significant moves, especially when combined with unique borrow metrics. What is cost to borrow and why it matters? Animate CTB explanation. So, what exactly is cost to borrow or CTB, and why is it so crucial? When a short seller wants to bet against a company like BIYA, they first need to borrow shares from existing shareholders, usually through their broker. They then sell these borrowed shares in the open market, hoping to buy them back later at a lower price and return them to the lender, profiting from the difference. But borrowing isn't free. Short sellers have to pay a fee, typically expressed as an annualized percentage, which is the cost to borrow. This fee reflects the supply and demand for shares available to lend. If many people want to short a stock, but there are very few shares available to lend, the fee skyrockets. You might think fees can't go over 100%, but they absolutely can, sometimes reaching hundreds or even thousands of percent annually because the demand to short vastly outstrips the supply of lendable shares. Why the stock is hard to borrow right now. Highlight BIYA CTB number. Now let's zoom in on BIYA specifically. Our screener flagged BIYA because its cost to borrow fee is an astonishing 897.1% annualized. Think about that, almost 900% just to hold a short position for a year. That's a massive burden for any short seller. While we don't have current data on the exact number of shares currently available to borrow, a CTB fee this high indicates that BIYA shares are extremely difficult or hard to borrow in the current market. This tells us there's a significant imbalance between the desire to short the stock and the supply of shares available to do so. This scarcity, combined with BIYA's estimated float of just 2.7 million shares, creates a very tight environment for short sellers. Our internal composite squeeze score, which weighs factors like CTB, float size, and momentum, currently sits at 43.5 for BIYA, indicating a situation worth monitoring, especially if activity picks up from its current low levels. Squeeze mechanics explained. Animate short squeeze process. So, what happens when a stock is hard to borrow and the CTB is sky high like it is for BIYA? This sets the stage for what's known as a short squeeze. Imagine short sellers are trapped paying exorbitant fees day after day just to maintain their positions. If the stock price starts to tick up, or if the supply of available shares to borrow shrinks even further, the pressure on these short sellers intensifies. They might start covering their positions, meaning they buy back shares in the open market to return them to their lenders and stop the bleed from the CTB fees. This buying pressure, especially on a stock with a small float like BIYA's 2.7 million shares, can push the price up even higher, forcing more short sellers to cover, creating a cascading effect to short squeeze. It's a vicious cycle for shorts, but it can be explosive for the stock price. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. Show no dilution graphic. Before getting too excited about squeeze potential, we always run a dilution risk check. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This can happen through various means, like secondary offerings -1, -3, 424B filings with the SEC or convertible debt. New shares entering the market increase the supply, which can effectively offset or even negate the upward price pressure from a short squeeze, even when the cost to borrow is extremely high. More shares available means short sellers might find it easier to cover their positions, or the float effectively gets larger, making it harder for buying pressure to move the needle. For BIYA, our check shows no recent dilutive SEC filings found in the last 90 days, which is a positive sign for any potential squeeze thesis, as it means the existing float isn't being artificially expanded by the company. Furthermore, we found no recent reverse splits for BIYA, which can sometimes manipulate share counts and create confusion. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show B chart, pause. Given BIYA's current state of 0% price change and 0 volume, what should we be watching for if the stock is to become a squeeze candidate? The primary signal would be a significant increase in trading volume. From 0, even a few thousand or tens of thousands of shares traded would be a notable change. Highlight volume BIYA. This increase in volume, especially if accompanied by any upward price momentum, could indicate renewed interest or short covering activity. Given the tiny estimated float of 2.7 million shares, relatively small buying pressure could have a disproportionate impact on the share price. We'd also ideally want to see if the available shares to borrow continue to shrink, or if the cost to borrow rises even further, adding more pressure on existing shorts. These are the early indicators that could suggest BIYA is moving beyond its current dormancy. Show BIYA ticker and logo again. So there you have it. BIYA presents a fascinating case study with its astronomical 897.1% annualized cost to borrow and its tiny estimated float of 2.7 million shares. While the stock has been exceptionally quiet in terms of price action and volume, these underlying hard-to-borrow metrics are definitely worth understanding. Remember, a high CTB creates a challenging environment for short sellers, but it doesn't guarantee a squeeze. We'll be keeping an eye on BIYA for any signs of increased volume or price movement that could signal a shift. If you found this breakdown insightful, please hit that like button, subscribe for more in-depth analysis of hard-to-borrow stocks, and let us know in the comments if there are any other tickers you'd like us to put through our screener. Thanks for watching, and we'll see you in the next one.